The best leading indicator of a recession has been flashing warning signs again. In this video, I will explain this indicator and then talk you about how you can protect your assets. In addition to this, the massive sell-off that we saw around the world the other day was a telltale sign of a recession coming. Also, don't be fooled by the current share prices of the world's largest companies. Although these look good, asset prices are often at all-time highs just before a recession. Paired with this, if you've been following stock prices, you will notice how much volatility there is currently in the markets. Now, before every recession, there's some clear factors that most people miss. Yet, when you know what they are, they can enlighten you. The first one is some form of external shock. That can become the catalyst. This can be things such as a natural disaster or even a pandemic causing significant supply chain shocks. Didn't we have one of those recently? Sorry about that. Or geopolitical tensions such as wars, trade tensions, political instability, again, war in Ukraine, Gaza, US elections, UK riots, tick, 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 just to name a few. Then finally, economic slowdowns, including GDP and international trade growth slowing down. Again, tick. In addition to external factors, we also see an increase in psychological factors. Things such as decreasing consumer confidence, resulting in reduced spending and economic slowdowns. This is actually very apparent if you look at the used car market, new car market, luxury watches, etc. Panic selling and market corrections. Again, something that we've seen a lot recently. For example, on the 5th of August, we saw the Dow Jones drop 1,000 points following a sell-off in the Japan's nickel market. This is often coupled with increased FUD, with media coverage and economic reports over-exacerbating downturns. Paired with both of these, we're experiencing signals such as rising interest rates. These are designed to control inflation, but as a result, this can reduce spending and investments. Declining consumer spending, again, often resulting in lower business revenues and layoffs. Finally, an inverted yield curve, indicating the potential recession when short-term interest rates exceed long-term rates. Again, we have experienced all of these things over the last few years, which is a bit concerning. Now, the problem we often have when predicting a recession is that most of the indicators are lagging. Often what we don't realize is these are 3 to 9 months behind, so a recession can be in full swing before we even realize. Therefore, we have to rely on a number of leading indicators. These can include things such as the yield curve being inverted. Secondly, we experience durable goods orders decreasing, meaning a slowdown in manufacturing and consumer spending. Third, the SAM's Raw Recession Indicator, showing when national unemployment rates rise by 0.5% or above relative to the minimum of the 3-month averages from the previous 12 months. Again, we've recently seen this. And finally, my favourite, the LEI, the Leading Economic Indicator, which combines 10 different indicators and is used to forecast turning points in the economy, typically 6 to 12 months in advance. A decline in LEI suggests that there's a higher likelihood of an upcoming recession. The LEI is comprised of the following indicators. Firstly, the average weekly hours in manufacturing. Secondly, the average weekly initial claims for unemployment insurance. Third, manufacturers' new orders for consumer goods and materials. Fourth, the ISM, the index for new orders. Fifth, the manufacturers' new orders for non-defense capital goods excluding aircraft. Sixth, building permits for new residential property. 7, stock prices for the 500 common stocks. 8, the leading credit index. So number 9, this is the interest rate spread. And finally, number 10, the average consumer expectations for business conditions. As you can see from the LEI, it's been recently flashing warning signals for a recession. However, it's showing signs of trending less negative currently, so we are on a complete knife edge. The July data was accompanied with the following statement, so this is slightly concerning. The statement reads, in July, weakness was widespread among non-financial components. A sharp deterioration in new orders, persistently weak consumer expectation of business conditions, and softer building permits and hours worked in manufacturing drove the decline, together with the still negative yield spread. Therefore, the data continues to suggest headwinds in economic growth going forward. Well, I don't know about you, but that doesn't sound great to me. In addition to this, the Fed is about to lower interest rates, which has preceded every recession to date, which, although it doesn't necessarily mean that we are going to go in a recession, it quite often typically occurs that way. Now that we understand what typically happens before a recession, combined with the indicators to look out for, I want to share my thoughts on how you can protect yourself and how I personally plan to protect myself going forward. Firstly, the most important thing to do is pay down all of your non-mortgage debt and ensure that you don't take any more on. As you can imagine, high interest debt combined with potentially losing your job can be catastrophic. Secondly, build an emergency pot. People recommend 3 to 6 months of expenses is required to ensure that you have a good nest egg and can survive if you lose your job. Now, once you've paid off your debt, this is a great time to start continuing investing. As Warren Buffett famously said, when there's blood on the street, this is when you should be buying. In other words, when times are scariest, this is when you can make the most money, as people often sell and won't buy when they think the world is ending. However, over the long term, indices such as the S&P 500 have always gone up, as you can see here. The key thing to do in a recession is to try not to time the market and especially try to avoid panic selling. Here you will see how trying to time the market can significantly impact your portfolio using 20 years worth of data from JP Morgan. As you can see, if you miss the top 10% of trading days, you'd have shed 54% of your potential gains. And that increases to 93% if you miss the top 60% of days over a 20-year period. To help with this, you should dollar/pound cost average. Here you invest a fixed amount regularly. This strategy helps to reduce the impact of market volatility. This ensures you buy less when share price is high and you buy more when it's lower. Next, if you want to buy individual stocks, focus on defensive stocks. These include things such as consumer staples, so companies selling essential goods like food, beverages, and personal care products. Next, healthcare. Demand for healthcare services always remains relatively stable. And finally, utilities, as people will always need electricity, gas, and water regardless of economic conditions. Finally, when investing, remember your key principles, including ensuring that you're diversified. Have a long-term perspective and focus on the longer-term goals rather than any short-term market fluctuations. Manage your risk and risk tolerance, understand your personal risk, and invest accordingly. And finally, if you need to, consider consulting a professional, as these can help you to tailor your approach. Also, if you feel that any of your stocks are overvalued, don't be afraid to sell those and rebalance your portfolio with stocks that you feel are undervalued. Now, to summarize, first pay off your debt and build an emergency fund. Then invest what you can by dollar cost averaging. If you don't feel confident picking individual stocks, then focus on buying large indices such as the S&P 500 and the Nasdaq. Good luck protecting your assets and maximizing your return. If you've liked this video, please consider subscribing, and also you may find this video here useful.